Very good morning, friends. So I hope you're all doing well. And of course, I always keep saying that at the beginning of the class, that I hope your cumulative revision is going on. So we've covered quite a bit so far on financial instruments, and we were focusing on the financial assets accounting. We've seen the initial and the subsequent measurement based on a three-step model. And I've also covered three special issues with you. One is with reference to transaction cost, then processing fee, and then the difference between a transaction value and a fair value, in which we also created a three-step model. A couple of three-step models we've already covered. Now, before I take you to financial liabilities, there is one small little special issue more on financial assets. Oh my God. You must be thinking so many agendas related to the financial assets. Yes, we've got one special little, I would say, warm-up exercise for the day before we talk in terms of financial liability, and that is called a prepayment of a loan. Let's say, for example, if you got a financial asset and in this particular case, the borrower makes a prepayment of the loan, how does it get accounted for? Because I think this has also been an examination question, I think at least once or twice, I guess, if I rightly remember. So let's, I think, start with a warm-up exercise that is a prepayment of a loan, and then I will come to the concept of financial liabilities. So let me, I think, first take to a small little example. So this is a small little example which is dealing with the concept of a prepayment. So let's, I think, read. I guess this is visible, I hope. So let me just read the facts to you out here. It says, A Limited is a policy of providing a subsidized loan to its employees. You know, the moment I read that there is a subsidized loan to the employee, immediately what comes to my mind is also the transaction value is not going to be equal to the fair value. If it is a concession loan, there is an employer-employee relationship which would also lead to a difference between a transaction price or value vis-a-vis a fair value. Then he says Mr. X, who's executive assistant to the CEO of A, took a loan from the company on the following terms. You're given the principal amount. You're also given the interest rate is 4% on the first 4 lakh rupees, and it is 7% for the next 6 lakh rupee. So there is an interest which is on a slab system. We've got interest which is at the rate of 4% for the initial 4 lakh and 7% for the next 6 lakh. And the start date is January 19 and the tenure is 5 years. Then he gives you what we are focusing on is a prepayment option. It can be full or partial prepayment at the option of the employee. So what we are focusing today at the start is that if there is a prepayment in terms of financial asset, how it is to be accounted for. Then it says the principal amount of the loan is recovered in 5 equal annual installments and will be first applied to 7% interest bearing principal. So it says the principal is recovered in 5 equal installments, and we are going to consider that the first amount is towards the 7%, which means we are going to first repay the portion which is at higher rate of interest. The accrued interest is paid on an annual basis, and Mr. X must remain in service till the end of the term of the loan ends. And I guess if you remember in the previous class, I also told you that that doesn't make a difference. Even if there is no condition which is attached to the loan, that would not make any difference to the accounting. The market rate of interest for a comparable loan is at the rate of 12%. So one thing is pretty clear that this is the contracted rate, which is 7 and 4%. And this is the market rate, which of course is not equal, telling us very clearly that this is an off-market transactions. And we can clearly see that there is an employer-employee relationship. And because of the employer-employee relationship, the difference in the transaction and fair value is going to be treated as employee benefit cost, which we are going to defer it for the period of the loan, which is 5 years. The following table shows the contractually expected cash flows from the loan. So we're already given a chart where there is a repayment of the principal money in 5 equal installments. One of the portion goes on the next page. Then there is an interest income at the rate of 7% on 6 lakh rupees, which is 6 lakhs into 7%, but then it is declining because of the repayment of principal. And there is another interest income at the rate of 4% as well. So whenever the company is making a payment, we're assuming the payment is towards the 7% interest. So this is, you can say, reducing 4 lakhs into 7% out here and 2 lakhs into 7% and so on. So this is the status of the outstanding principal as well. So whatever payment is being made is first, it says made towards, you can say, the 7% interest payment. Thereafter, we are given some more inputs as well. So this is another payment which is defined, that is the 5th year. Then he says Mr. X prepays 2 lakh rupees on December 2020, reducing the outstanding balance at that date to 4 lakh. So there is a clear-cut case of a prepayment. So we need to see how this prepayment is to be accounted for. And then it says the following table shows what is the actual cash flows. In the previous chart, we were given the contractual cash flow. Now we're given the actual cash flows from the loan which is given to Mr. X, which is after considering the prepayment on December 2020. So you can see a slight little change that the loan was given on January 19. The first installment is paid on December 19. And when the second installment is paid, a prepayment is made at the time of second installment. And then accordingly, the interest calculations have also undergone a change because the outstanding principal gets reduced by 4 lakh rupees compared to the expected 2 lakh rupees each year. You're required to record the journal entries in the books of A, applying the requirements in terms of Ind AS 109. I guess you would have fairly understood the question. That's not a big challenge. The crux of the question is that there is a financial asset. An employer has given a loan to the employee. So I would say this question is a blend of a transaction value vis-a-vis a fair value and also considers the concept of prepayment as well. So the company had given a loan to the employees, and in this particular case, there was an agreed contractual cash flow. But the employee in this particular case made a prepayment. So the question is, how do you tackle this prepayment in terms of both the loan as well as the prepaid amount as well? So what we're going to do at the initial, we're going to start the question absolutely in a normal manner. Normal manner in the sense that I just need to consider that what is the fair value, what is the transaction value, get the amount of, you can say, prepaid staff cost. And then we can see after a period of 2 years when the prepayment is made, how it is to be accounted for. So the kickoff, the start of the question is going to be done exactly the normal way itself. So I think let's begin the journey. So in this particular case, what I am going to do at the very start, I'm first of all going to organize the transaction value and the fair value. So let me also put it down that what is the uniqueness of this particular question. The unique point is that there is a difference between a transaction value and a fair value. And along with this, there is a concept of prepayment. So we're looking at how does the prepayment make an effect on the question when there is also, you can say, a difference between a transaction value and a fair value as well. So let's first of all consider what is the transaction value in this particular case. So the transaction value is the amount of money which the employer gave to the employee. So I think in this case, it is straightforward 10 lakh rupees. The principal amount of the loan is to the extent of 10 lakh. So my transaction value in this particular case is 10 lakh rupee. And we also need to consider the fair value as well. And in terms of fair value, what do you need to consider? The present value of all the inflows, that is the present value of all the contractually agreed cash flow. And in this particular question, the chart is already given to you. He's already given at the very inception itself that what is the position of the contractually expected cash flow. So what we can do, we can consider the principal repayments and the interest incomes as well. So we've got the inflow in terms of principal each year contractually agreed. We've got the interest inflow each year. We can just consider the discounting. I guess you would be comfortable if I directly consider the present value. The idea is not to teach you the concept of discounting. I'm just going to consider directly the present value of all the future inflows contractually agreed. I hope that is comfortable indeed. So in this particular case, what we're going to do, when we're going to consider the fair value, we will consider the present value of the contractual cash flows. And the contractually agreed cash flows is already given as a chart in the question. That's great. So we're just going to pick up the figures and I'm just going to directly consider the present value. So once you discount all these inflows at the rate of 12%, which is the market rate of interest. So this discounting is going to be done at the rate of 12% itself. And once you do all the discounting, we're going to get the figure 843,934. 843,934. So we're going to get the difference in this case, and this difference is the difference between a transaction value and a fair value. So I think this we've seen earlier also in the previous class, that when you are considering a fair value, whether it's an asset or liability, you just need to consider the present value of the outflows for a liability, the present value of the inflows for the asset, and that gives you the fair value. So let's see the difference between the transaction value and the fair value in this case. I guess it comes to 156066. That is the difference, which is the transaction and fair value gap. So let us also now see what is the journal entry which we are going to pass at the very inception. So in the books of the employer, this is the entry in the books of the employer who is given a concessional, or you can say a subsidized loan to the employee. So we're going to put the entry that is loan gets a debit. In the brackets, I'm calling it as a financial asset debit. And the bank gets a credit in this particular case. The loan is going to be recorded at, you can say, the amount of fair value 843,934, and the bank is recorded with the transaction value, and any difference in this entry is the prepaid staff cost, which is going to be amortized over a period of 5 years. That is the period of the loan. So this is the balancing figure which we have already computed, 156066. I guess so far so good. It's all pretty simple and straight indeed. So what we have done basically, we at the very start of the question were clearly able to identify that there is an off-market transaction, and in this particular case it is an employer-employee relationship. So the difference is accounted as a prepaid staff cost. Now, what we are going to do in this particular case, we are going to make a total of 2 ledger. I would say let's make a loan account ledger separately and a prepaid staff cost separately. We need to do this for the 2 years up to the date of prepayment. So let's make the ledger account absolutely in a normal manner, just like you do a normal ledger account. So let me make 2 separate ledgers at this particular stage. One is the financial asset, which is the staff loan, and other is the prepaid staff cost as well. So let me consider a loan account, which is the financial asset in the books of accounts, and let's also consider the prepaid staff cost as well. So we'll first post the entry which we have done at the very inception and then take the accounting forward. So first of all, we've got a loan account 843,934. So this is 843,934. This is bank. And similarly, we can consider the figure that is prepaid staff cost debit and bank gets a credit. That is, I think, 156066. If I am right, yes, that is correct. So this was just a posting of the initial journal entry, which is done at the very inception. Now let's make the financial asset at amortized cost in a normal manner. You need to accrue the interest at the rate of 12%. So what is indirectly, I always say that you've taken a present value of all the inflows at 12%. Now you're going to basically compound. You did a discounting, now you need to do a compounding, or you can call it as unwinding of discount. So let's consider the finance income at the rate of 12% on this particular figure. So let's see what's going to be the 12% interest. 843,934, 12% on the outstanding balance. That is 101,272. And then we also received some money at the end of the first year. And for this purpose, you're already given a chart in the question because everything went smoothly the way it was agreed contractually. So I think we can just go back to the chart given in the question. And let's see what was the amount received. So we can clearly see that 2 lakhs is received at the end of first year and another 42 and another 16. So all this amount of 2 lakh principal plus the interest of 42 and 16, that makes it 258. So contractually agreed inflows, 258 received at the end of the first year. We can comfortably take a balancing figure, which is the balance CD. So let's see the balancing figure in this particular case. So this would be 843,934.
867,206.
867,206. Great. I was just wondering, Beta, where are you? Because you helped me with all the calculations indeed. Thank you. Okay, so let's take this as a next year balance as well. We get a balance BD, which is 867,206. So we'll again do the unwinding in terms of the finance income at the rate of 12% on this balance. I guess that is 104,065 approximately, rounded off. But now at this particular stage, what we are getting is not the sum total of 2 lakh rupees, but there is a prepayment as well. So let me split the amounts in terms of 2 elements. Let me just go back to the contractually agreed inflow. So we can see the contractually agreed inflow, that was 2 lakh rupees plus 28 plus 16. So this was contractually agreed as principal plus interest, and that works out at 244. But apart from this 2,44,000, we also received a prepayment to the extent of 2 lakh as well. So let me just quickly pinpoint that this 2 lakh rupees is supposed to be a prepayment. This 2 lakh rupees is supposed to be a prepayment. Now, hear me carefully. I cannot afford to record this 2 lakh rupees in the loan account. Hear me carefully. This is the crucial point why we are doing this particular question, that once there is a prepayment, you cannot take this entire 2 lakh rupees in the loan. There is some amount which is attributable to the loan, and there is some amount which is attributable to the prepaid staff cost. So what we need to do in this particular case, we need to get the bifurcation of this 2 lakh rupees. You cannot record this entire 2 lakh rupees out here. That is the main issue, which is the accounting treatment. So I've done absolutely the usual accounting, but when there is any kind of prepayment receipts on this particular loan, you need to split this 2 lakhs into 2 components. Some portion is towards the loan and some portion is to be adjusted towards the prepaid staff cost. Now, how we are going to make the adjustments, we'll see. Let's first do one thing. Let's come on to the prepaid staff cost as well. This is going to be amortized annually. So 1/5 of this is going to be amortized each year, because this is to be spread over the period of the loan on a straight line basis. So 156,066 divided by 5, that's 31213. And we get a balance CD as a balancing figure. So let's see what is the balance CD in this particular case. I guess 124,850. That's going to be 853 approximately.
Yes, sir.
So 124,853. And again, we amortize that 1/5. That is 31213. Okay, so now we're going to leave the ledger at this stage itself. So what I've done, I basically done the usual accounting at this particular stage. The financial asset is accounted usually. The prepaid staff cost, which is spread over the period of straight line, is done accounting usually. Now the basic objective is that when the employee gave a prepayment of 2 lakhs, we need to do the split of this particular amount. So let's do one thing. We're going to first of all concentrate on what is the outstanding balance at this stage. So do one thing, just give me a balance of this particular ledger at this particular stage. Just take the figures, which is the opening plus the finance income minus the interest and principal receipt. So let's see what is the balancing figure at this particular stage.
Sir, it is 7,27,000.
Okay, so this is coming to, can you come again? 7 lakh.
7,27,271.
271. Great. So 7,27,271 is the amount which is coming at this particular stage. Okay. So we are now with this particular balance. And now let's have a look at the further inputs. I sure is 727 because I think I have some different figures with me. So this is coming to, I guess, a total of, let me just check the ledger once again, 843, that is correct. 687, just see, is this figure correct? I have my doubts on this particular figure.
Sir, it was 6,87,206.
Oh, I thought as much.
87,000.
I was wondering from starting why this figure has been written here.
Okay, not an issue. So let me just get the figures again. Can you just give me the figures once again on this?
6,67,206.
667,206.
87. 6,87,206.
687,206.
Yes, sir.
Yes.
687,206. So this becomes the opening balance in the next year. Let's take a 12% interest on this.
82,465.
Great. Now better take the balancing figure at this particular stage. What is coming in?
525,671.
Just a second.
525,671.
525,671. This is the balance in the loan account. Great. And let's also see what is the balance in the prepaid staff cost as well. So we'll take the balancing of both the ledgers. So let's see what is the balancing figure in the prepaid staff cost also at this particular stage. 124,853, 31213. I think it's 93,640. Just verify this. Is this the figure, I guess, for this year as well?
Yes, sir.
Okay. So this is the inputs, what we are getting at this stage. Now we need to see the real calculations in terms of the prepaid staff cost. Well, I would say you need to basically calculate now the fair value of the loan all over again. So whatever are the contractual cash flows which are left over, you need to consider the present value of all those cash outflows at this stage. So what we're going to do at the time of prepayment. So in this particular case, at the time of prepayment now, we're going to again calculate the fair value, which is based on the remaining cash flows to be discounted at the rate of 12%. So in the question, you're also given a chart where the actual cash flow status are given. So let's go back and see what is the remaining cash flows at this stage. I guess if I look at the remaining cash flows at this particular stage after the prepayment, this is the status now. So I guess if you permit me, I'll just directly take the present value of the remaining cash flows and calculate the fair value of the financial asset. I think calculating is not a big issue. So whatever is the remaining cash flow, let's consider the present value of those figures. So we will take at the time of repayment the fair value at this stage. And this is going to be based on the present value of remaining cash flows. So let's see what is the present value of the remaining cash flows in this case. I'll give you the figure directly itself. I think that is coming to 358. This is coming to 358 and this is 358664. Okay, so what I've done basically, I've organized the inputs in terms of the financial asset book value and the prepaid staff cost book value, which is available in the ledgers. And now we are just calculating the fair value based on the remaining cash flows discounted to time value money. Now, what we need to do at this particular stage, we need to make a comparison of this book value and the fair value. Whatever is the difference is going to be a reduction in the loan value. So once we get the reduction in the loan value, we know that we paid a total of 2 lakh rupees. So from 2 lakh rupees, if we reduce that reduction, we're going to get the reduction in staff costs. So let's first see what is the difference in these two values. The book value versus the fair value.
167,007.
Sorry, can you come again?
167,007.
Okay, so this is the difference between the book value and the fair value. 167?
007.
Okay, 007, sorry. So 167,007, that is a difference in terms of the book value versus the fair value based on the present value of the remaining cash flow. So but that means that when the employee made a prepayment of 2 lakh rupees, out of that 2 lakh rupees, this 167,007 is supposed to be a payment towards the loan. The rest difference is a payment towards a prepaid staff cost. So we are going to compare this now vis-a-vis 2 lakh rupees and let's get the difference which is to be adjusted against, which is going to be adjusted against the staff cost as well. So 167, so
32,993.
32,993. This is the amount adjusted towards the prepaid staff cost. Okay. So let me just, I think, quickly take a recap of the calculations. The accounting is pretty simple and straightforward indeed. So in this particular case, when the employee made an advance payment, what we did, we just compared the book value at the time of prepayment and we compared it with the fair value of that particular loan, which is based on the present value of all the remaining cash flows. Once you compare the book value vis-a-vis the fair value, the difference is the amount out of that 2 lakhs, which is prepaid, how much is to be adjusted against the loan. And from the 2 lakh rupees, when you compare the difference, you come to know how much is adjusted towards the prepaid staff cost. So now we're going to go back to the ledgers and see what we are going to record. So we go back to the ledger account. And in this particular case, now the amount to be recorded in this case is 167,007. And the amount in this particular case to be recorded against this is the difference we've calculated, which is 32,993. So accordingly, now we get a balance CD as a balancing figure. And here also we get a balance CD as a balancing figure. And of course, the subsequent accounting would of course continue on similar lines itself. So let's see what is the balancing figure, which is going to be the fair value only. You can directly pick the fair value as well. So the fair value which we computed was 358,664. This is 358,664. And we can get the balance CD for the prepaid staff cost as well.
6647.
Right, 60647 is the balancing figure. Now this is going to be spread over the remaining 2 years. 2 years, I think 3 years are left, right? Okay, so this is going to be spread over the remaining 3 years now on a straight line basis, and this will be done, a usual accounting in this particular case will continue the way amortized cost accounting is done. Simple and straight indeed. That was a warm-up exercise before we get into some kind of technicalities today. Right, so that was one special issue which I wanted to discuss. So we have discussed, I would say, now 4 special issue. I've given you the concept of TC, the concept of processing fee, and the concept of transaction value, fair value. You can say this is like a sub-special issue within the third issue, that when there is a transaction fair value differences, how do you actually account for the prepayment as well? So you can take this as a special issue within the third special issue if you technically look at this. Great, so far so good. I hope everybody is pretty clear with this particular concept. Okay, so I guess the warm-up exercise bit is done. Now I am going to discuss the accounting of financial liabilities. Now this might be a bit tricky as I move. You know, in the previous class towards the end also, I'd given you some insights about financial liability. I'm just going to come back to it. So you might feel a little technical to begin with, but don't worry, we'll make some notes very soon on that. But first hear me very carefully, because few things what I'm going to tell you is something which we are yet to study. So that might be a little difficult, insight, but I'll give examples to illustrate the agenda. So let me now come to the agenda in terms of financial liabilities. Don't worry on the notes. We'll make the notes later. Let's first, I think, read the inputs in terms of financial liabilities. So let me remind you, I'm back on the concept of accounting for financial liability. And let me also again remind you, all financial liabilities are initially taken at a fair value. Just like all the financial assets are taken at a fair value, all the financial liabilities are taken at a fair value, with the same 2 kind of exceptions. Number 1, if it is a trades payable, and number 2, if it is a loan which is payable on demand. So except these 2 liabilities, all the liabilities will be taken at a fair value. And now we need to see that once you subsequently measure the liability, what are the various categories? So the emphasis point again is the categories which I'm giving you for financial liability is for the subsequent accounting. The initial measurement of all liabilities is at a fair value. So all what we are doing is for the subsequent accounting. So let's see what are the various categories in which the financial liabilities are classified for the purpose of subsequent accounting. Let's have a look. It says very clearly, upon initial recognition, all financial liabilities are measured at a fair value. And I already gave you the exceptions as well. Don't worry, we'll make the notes also very clearly. One is in terms of trades payable and one is in terms of loan payable on demand. Then it says subsequently, so all these categories is for the balance sheet date. The classifications of financial liability shall be as follows. One is called measured at amortized cost, and I would say this is more like a default category of the financial liability. And I'll give you an option now. Though I think we've come a long way, but I'll still give you an option. One option is that I make your life simple and I just tell you that effectively there are 2 categories of financial liability. One is we can say financial liabilities at AC, and one is we can say financial liabilities at FPTPL, and make your life simple. The other way is that I give you all the categories of financial liabilities which are yet to come as well. And then maybe when we come to those things later, I remind you back that yes, I told you that these categories are there. So you want me to make your life simple or you want me to make your life complex at this stage? The choice is yours. Shall I make your life simple at this stage or complicated? Complex? Okay, then if you want this, I do that. Let's then have a read now on the different classification. So A is measured at AC, then it says measured at a fair value through P&L. This is called FPTPL. And in this particular case, he's telling me the categories of liability which are going to be taken in this case. Liabilities that meet the definition of held for trading. I would say basically mainly derivative liabilities will enter in this particular category. And then it says contingent consideration, which is recognized in a business combination. So let me tell you in advance. Don't worry, I'll make the notes later. We are also going to cover after financial instruments the plethora of standards on consolidation. And one of the initial standards, what we're going to start is Ind AS 103. For the time being, just for understanding, let's assume something what you've done in amalgamation in CA Intermediate. It's like, A Limited took over the business of B and he paid a consideration. Now, in this particular case, you'll see in 103, Ind AS 103, that when A takes over the business of B and gives a consideration to the shareholders of B, so the consideration at times can be dependent upon certain terms and conditions. And that is called a contingent consideration. So it's like, a purchase consideration given to the shareholders of the acquiring company. And this consideration is dependent upon certain ifs and buts. So when that consideration is not paid at the time of acquisition, but it is paid later, we can say it can be a contingent consideration. So in simple words, something paid at a future date with certain ifs and buts makes it contingent. Now, in Ind AS 103, we'll see that contingent consideration is to be measured at a fair value initially. And not only it is measured at a fair value initially, but till the time it is discharged. Till the time it is discharged, the contingent consideration is to be measured, remeasured at a fair value, and all the fair value gains and losses will enter the P&L. So the reference which is made out here is that there is a contingent consideration recognized by the acquirer in a business combination, that is Ind AS 103. So when we're going to go to Ind AS 103 and we're going to discuss the concept of a purchase consideration, I'll remind you that in Ind AS 109, it was clearly given that if there is a consideration which is paid in the future, and it is based on ifs and buts. Now, we're not talking of what are those ifs and buts. So if there is some kind of a payment which is made in the future, and based on ifs and buts, that is called contingent consideration. That contingent consideration is measured initially at a fair value and even subsequently at a fair value, and indirectly we can say FVTPL, where the changes in the fair value of that consideration is going to be taken in the P&L. I hope I made sense. Then it says designated at a fair value through P&L. This is again FPTPL. Now we need to understand the distinction between the B and C. If you consider that there is a liability which is held for trading, derivative, for example, or there is a contingent consideration, it is classified as FPTPL. But if you remember my discussions with reference to designating the financial assets at FPTPL, so financial assets and even financial liabilities may meet the criteria of amortized cost. But the company, because of elimination or reduction of accounting mismatch, as we've seen earlier, could decide that these financial liabilities, instead of being taken at AC, will be measured at FPTPL. And that's called designated at FPTPL. Now you would say, so what's a big deal? B category is also FPTPL and C category is also FPTPL. But the interesting part, hear this carefully. In case of B, the fair value changes will go to the P&L. But in terms of C, the entire fair value changes will not go to the P&L. Some portion goes in the OCI and some portion goes in the P&L. Don't ask me at this stage which portion goes in P&L and which portion goes in OCI. We'll see that. But we'll not get into the length of detail. How do we split that particular portions and all? But yes, you need to know that yes, out of the entire fair value change, what portion goes in P&L, what portion goes in OCI. So the difference between these two is that in terms of B, the entire fair value changes goes in the P&L. In terms of C, when the instrument is designated at FVTPL, the fair value changes are split and it is partially in P&L and partially in OCI. Then there is a fourth category which says other specific measurement basis with changes taken in P&L, which is again FVTPL. Wow. So he's giving you B, which is FVTPL. He's giving you C, which is designated at FVTPL, and other specific measurement bases where the changes are again taken in FVTPL. Now, there are certain special cases of financial liabilities as well. And I guess in terms of cases, we can look at two special agendas now. It says financial liabilities that arise when a transfer of a financial asset does not qualify for derecognition or when the continuing involvement approach applies. Now, all I can say at this particular stage, what we're doing right now is the recognition of financial assets and financial liability, which means recording them in the balance sheet of the company. Soon we are also going to come to the concept of derecognition, which is removal of the financial assets and liability. So as of now, what we are studying is recognizing an FA and FL in the books. And now we're going to go do what is called a derecognition, a removal of the FA, FL from the books of accounts. Now, at this stage, I can only tell you that when you remove the financial asset in the books of accounts, it's not on an arbitrary basis. We're going to see some very interesting kind of tests which are given in the standard, and those tests tell you that whether you can remove the financial asset from the books or not. Mind it carefully. For example, I am looking at a bill discounted. So if you remember in terms of school, you used to put the entry bank account debit and bill receivable gets a credit. So when you are giving a credit to the bill receivable, you're basically eliminating, or you can say removing, or you can say derecognizing a financial asset from the books of accounts. But Indus 109 gives you the parameters that a derecognition or removal of the financial asset is going to follow a certain set of principle, a certain test, certain kind of test. And sometimes it may happen that the removal of the financial asset does not get qualified. That means once I apply the principles of removal of the FA, it may not get removed from the books of accounts. Therefore, it says that when a transfer of financial asset is not qualifying for a derecognition, then in those cases, instead of putting the entry, mind it carefully, instead of putting the entry bank debit FA credit, we're going to put the entry bank debit FL credit. You know, when you derecognize the asset from the books of accounts, you put the entry bank debit financial asset gets a credit. But in these cases where the asset cannot be derecognized, we'll put the entry bank debit FL credit. So when the financial assets would not qualify for removal from the books of accounts, there might be a need to recognize a financial liability. And there is something else also called a continuing involvement approach that we'll see later. Now, in this particular cases, let me tell you that in this case, when you look at financial liabilities in this particular case, how are they accounted for? We are going to see when we come to the derecognition of financial assets. And then it says financial guarantee contracts and commitment to provide loan below market rate of interest. I guess my focus is only on the financial guarantee contracts. So if somebody were to tell me that, can you tell me in summary, how do you account for financial liabilities? Hear me carefully. I'll document that as well. I would say if you're looking at initial measurement, it is always at a fair value, with the exceptions trade payable as well as a loan payable on demand. If you're looking at a subsequent accounting of financial liabilities, I would say broadly there are four categories. I would say one is a financial liabilities at AC, which is a default category. One is, I would say, is a financial liability which is measured at FPTPL, typically derivative instruments, and I would say typically contingent consideration in a business combination. The category number three, I would say, is those financial liability which are originally at AC but designated at FPTPL. And the category number four is the specific measurements available for two kinds of liability. One is financial guarantees and one is financial liabilities which are created because a financial asset is not eligible for derecognition in the books of accounts. So a few of these liability, we have understood, the terms, but you're not able to visualize what is happening. No worry. I think if you're looking at this kind of liability, it'll take some time. But at this stage, I just want to pen down in your minds that we've got four categories of liability for the purpose of subsequent accounting. So one is AC, one is FPTPL, one is designated at FPTPL, and I would say other is a specific measurement base. Now, as far as this liability is concerned, we'll tackle in detail. Financial guarantee will tackle today only. And as far as the designated is concerned, we'll not really tackle it. Measured at FPTPL will tackle, and AC will tackle today. So which means I need to show you four cases. I need to show you the accounting at AC is done, but you've already got a flavor in terms of FL at AC. FPTPL also you've almost got a flavor, because FL at AC is nothing but the FL component of the CFI. And if you ask me in terms of FPTPL, nothing different as compared to the financial asset. Now, before we document these notes, I think I want to show you something more at this particular stage as well. As I made a little mention in terms of the designated liability, you need to have a very interesting look at this particular stage. Then I will document the agenda to you. So let's, I think, have a look at a very interesting chart which is given in the study material in the unit number 2. When they've made a discussion on the measurement of financial liabilities at a subsequent measurement. Let's have a look. So measurement of financial liability is driven by their classification upon initial recognitions. Now you can see either it is measured at AC, which is using an EIR that you already know. And then it says it could be a fair value through P&L liabilities, that is FPTPL. Now see this very carefully. I will not be able to take a question to prove this agenda because there is no question in the study dealing with this. So I'm just going to give you a conceptual knowledge without taking an illustration, because if I take an illustration, I think I'll spend the entire class giving you an illustration on this aspect. Now see, one thing in this particular case, it says unrealized gains or loss, which is other than the changes in own credit risk. It says other than the changes in own credit risk is recorded in the P&L. And then it says unrealized gains or loss for changes in own credit risk is recorded in OCI if it does not increase the mismatch. Well, all I can say at this particular stage, when a financial liability is designated at FPTPL, I said if the financial liability is designated at FPTPL, I need to identify what is the change due to own credit risk. I need to identify what is the change for other than the own credit risk. What is attributed to the own credit risk will enter the OCI, and what is attributed to other factors will enter in the P&L. So why? So why are you taking the changes in the own credit risk in OCI and the other changes in P&L? Well, that's difficult to explain without a practical illustration. So I will not get into the inputs, but I will just tell you one particular concept now. If you've got a financial liability which is measured at FVTPL, not designated by default, derivatives, contingent consideration, the entire fair value changes will go in the P&L. But if you've got financial liability designated at FVTPL, you need to split the fair value change attributed to the own credit risk and the other factors. What is attributed to the own credit risk will enter the OCI and the remaining enters in the P&L. So fair value changes for financial liability designated at FVTPL is going to be split in terms of two components. Portion relating to own credit risk in the OCI and the portion which is other than that in the P&L. Then it says realized gains or losses is recorded in the P&L. You can see another interesting input. This is unrealized gain or loss. This is unrealized gain or loss, but this is realized gain or loss. So, moral of the story. What do you say unrealized gains or loss? It is a remeasurement gain or losses arising at each balance sheet date, or in simple words, we can say fair value changes. When it comes to realized gains or loss, it means the removal of the financial liability. When the settlement of the liability has taken place, there is going to be a realized gain or loss. That is not split, but that is taken in terms of P&L. I think let me just put this all in a simple chart as well. Just like we did the concept in terms of financial assets, made a summary chart of what is the values at initial recognition, subsequent measurements, what do you do with the fair value changes, is the concept of EIR applicable or not, what is the treatment of TCs, etc. I think all needs to be done. So let's do one thing. Let's, I think, first map this bit to you. So what I'm going to do first, I am going to make an interesting chart, and then we're going to do things further. You know, in order to get a very good conceptual clarity of thoughts, I would say we need to go like this in a sequence. Let's see the few examples, case studies where you, now hear this very carefully. Let's see a few case studies and decide what is the category of FL. Identifying, is it a financial liability at AC, at FVTPL, designated at FVTPL, or related to specific transaction. So you're going to see a flavor of certain illustrations with the help of which you will decide what is the category. And then you come to the second aspect and see and learn the accounting initially and subsequently. And then I would say comes the special issue related to accounting, which is basically TC. We are not covering the concept of a transaction value and a fair value differences in terms of FL. That was mainly pertaining to financial asset. The focus is only in terms of TC and processing fee. So the chain of thought is that we need to divide our discussions in two parts. When you're looking at the case study and identifying what is the category of financial liability, and then you look at the accounting initially and subsequently with the special issue of TC, with the special issue of processing fee, but without looking into any TV versus fair value. That is not covered out here. Okay, so let's do one thing. Let's first make a chart very clear to you. Then we'll consolidate things also as we move further. But let's first make a chart on the different kinds of financial liability. Let's first make some notes to you. So my focus is now on the financial liabilities. My focus is now on the financial liabilities. And when I am focusing on financial liabilities, my focus again is initial and subsequent. So we're going to divide the discussions in terms of the measurement aspects in two parts. We're looking at the measurement at initial level, and we're looking at the measurement at each balance sheet date, which is on a subsequent basis. So the focus is on the measurements of financial liability. So when you look at the measurement of financial liabilities, initially, we know very clearly that they are taken at a fair value. The initial recognition of all financial liabilities is at a fair value. I'm not putting the TC at this stage, that I'll put it in the chart. And we can say there are two exceptions which we discussed for FA as well. The exception number one is on account of trades payable. And the exception number two is the loan which is payable on demand. So in these two cases, we need to record the financial liability at the transaction value itself. So let me put this, that this will be recorded at transaction value. So whatever is the value at which you've transacted, we're going to record the financial liability at the same value itself. Now, as far as subsequent measurements are concerned, I'm just putting the categories and then we'll make the chart. You need to first of all decide the categories of financial liability, and as we said, the categories are four in nature. The categories are four in nature. So we've got financial liabilities at AC. This, I would say, is more like a default category for us. If you're given nothing in the question, we are going to consider the financial liability AC. Rather, I would say you need to see that it is not special liability, not designated, not held for trading, then it is technically AC. The second is, we can say, financial liabilities at FVTPL. And this will be comprising basically, you can say, which are HFT, held for trading. That is one, and we could put it as CC. In case of business combination, CC in this case means contingent consideration. I've written CC. It is a contingent consideration in case of business combination, which we will see later. This is Ind AS 103. This is what we're going to cover later, not at this stage. This will come when we come to 103. We'll remind you. The third is that it is designated. The third is it is designated at FVTPL. The third is that it is designated at FVTPL. And when you say it is designated at FVTPL, we can say for the purpose of. This is designated for the purpose of eliminating or reducing. It is eliminating or reducing accounting mismatch. So you are doing this for the reason that you want to eliminate or you want to reduce the accounting mismatch. So you could designate the financial liabilities at FVTPL. And then finally, the fourth category of liability, what we are looking at is, we can say, special cases. This is special cases of financial liability. And I think in terms of the special cases, we are focusing, or let's put it here only. In terms of the special cases of financial liability, we are looking at FG. FG doesn't mean finished goods, financial guarantee. We're looking at financial guarantees, and we're looking at financial liabilities when financial asset cannot be derecognized. I need space, so I'll just put a little addition out here. Financial assets, when financial assets are not eligible for derecognition. They're not eligible for derecognition. So this is the permutation combinations of all kinds of financial liabilities. So let's get one thing clear. I'm going to cover the concept of EC today itself. I'm going to cover the concept of FVTPL today itself. Designated, no. Special issue financial guarantee, yes. Financial liabilities when FA is not eligible for derecognition, no. So we're not going to cover this special issue FL when FA is not eligible. We will only look at financial guarantee as a special issue. Designated we are not covering, but I'll give you conceptual notes. Fair value FVTPL we'll see only held for trading. Business combination we're not covering at this stage, and AC default yes. So I guess so far so good. At least some kind of a mapping must have been created in your mind that financial liabilities of four category AC, FVTPL, designated FVTPL, and some special liabilities, financial guarantees, etc. I think that's good enough to go. Now let's make a chart giving you a comparative inputs on how the accounting of these four categories are done. So let's make a very interesting chart at this particular stage. So few things I'll just make a mention, we'll cover later, but for the time being at least, we should at least give you all the inputs at this stage. AC, then FVTPL, designated at FVTPL, and special issue. So this is a summary chart before the practicals. We're looking at the summary chart, which is applicable to financial liabilities accounting initially and subsequently. So once we get this, we're going to go to the questions. We're going to do questions on two categories. One is looking at financial liability and seeing what is the category. Second is we're going to see how the accounting is done. So let's, I guess, consider the category. One column is particulars, then another column at AC, then FVTPL, then designated at FVTPL, and then we are looking at special cases. We're looking at special cases in this case. So let's begin the journey. Watch this very carefully as I fill the chart. I'm looking at, first of all, the initial measurement. How would the financial liabilities be measured initially? I'm not putting the concept of TC or the processing fees at that stage. You already know the concept of TC and processing fee for FAFL. I've already given you a separate chart. So in this chart, I'm not interested in inserting TC and the processing fee. So initial measurement will be at a fair value, will be at a fair value, will be at a fair value, will be at, okay, in this case, let's not call it fair value. Oh yes, let's call it fair value initially, not a problem. So it's going to be all at a fair value, and we've already seen exceptions. So all of them will be at a fair value with the exceptions, number one, trade payable, and number two, loan which is payable on DD, that is demand. So we need to keep one thing very clear. Initial measurements of all financial liabilities, any category, is going to be taken at a fair value, undoubtedly. Now let's have a look in terms of the second point. We are looking at subsequent measurement. We are looking at the subsequent measurement. Now, when I'm looking at the subsequent measurement, I am basically focusing on the fair value changes. And when I'm focusing on the fair value changes, my mind is working on the unrealized gains. I'm not looking at any realized gains at this stage. The fair value changes are the unrealized gain posted at the balance sheet date. So do we capture the fair value changes in terms of AC? No. In terms of FVTPL, yes, and it goes in the P&L. Designated at FVTPL, yes, but it is split. But in this case, it is split between OCI and it is split in terms of P&L. That is the distinction. Here the fair value changes goes in the P&L. Here the fair value changes are going to be split into two components. So what is due to? What is due to own credit risk? So let's not get into what is this own credit risk. So maybe conceptually to test you, they might give you an input that this is the fair value change. Out of this is the portion relating to own credit risk. And we can say which is related to other factors that will be entered in the P&L account. Then in terms of the special cases, as far as the financial guarantees are concerned, covered later. I'm not putting it out here, it is covered later. Maybe when you fill up this chart later for your own purposes, you can insert it out here. So how it is going to be measured, we'll see later in terms of financial guarantee. And the other one is in terms of financial liabilities, when financial assets are not eligible for derecognition, when they're not eligible for derecognition. In this case, we do not capture the fair value changes. Let me tell you in advance, though we'll see this later again. So get the picture clear. AC is not taken fair value changes, FPTPL fair value changes P&L, designated fair value changes P&L OCI, FG financial guarantee later, and those financial liability which arise when FA is not eligible for derecognition, the fair value changes are not taken. Okay, and then comes the third agenda, and that is with reference to, you can say, the concept of EIR. Is the concept of effective interest rate applicable in this cases? So in this case, yes. In terms of FPTPL designated, no. And this we can see later. I don't want to make comments at this particular stage. This will be seen later. So far, so good. I guess we've got some theoretical conceptual inputs in terms of financial liability. Which cases fair value changes captured? Where is it captured? EIR applies only for AC and nothing else. Right. I think now it's time to do some questions with you. As I said, I'm going to do questions in two parts. I will first now take you to questions where we're going to see financial liability case study. We will try to identify that is it AC, is it FPTPL, is it designated FPTPL. We're not looking at these right now. And then we'll see the accounting at AC and maybe FPTPL, how the accounting is done. Let's now go back to the study material. Let's have a look at a few questions now with you. So I'm coming now back to the study material, and we want to have now look at one or two questions where we can see what is the category. So let me just, I think, crop this bit. Let me just crop this bit to show you the inputs. I am looking at illustration number 29. 30th illustration we've already seen. 30th illustration we've already seen, but I just want to remind you back, we've already seen illustration number 30. I'm just now looking at illustration number 29. So right now we're looking at questions where we're just going to identify the category of financial liability for subsequent measurement purposes. It says in illustration number 29, a company purchases raw material from a vendor at a fixed price, 1,000 per ton of steel. The payment term provides 45 days of credit, after which interest at the rate of 18% shall be charged. How would you classify the creditors in the books of the company in this particular case? Well, let me ask myself a particular question. Do you see any kind of accounting mismatch stories out here? No. It cannot be designated at FPTPL. Do you see any kind of inputs that this is held for trading? No. So I would say in this particular case, the financial liability is in a default category of being taken at a AC. You know, I always work with the principle, let's go for elimination category. It is not held for trading, so not FPTPL. It is not an accounting mismatch case, so not designated FPTPL. In any case, it's not a case of special issue, so by default, it is AC. You agreed to pay the creditors after a payment of 45 days, and if it extends, you're going to pay 18% interest as well. So in the above case, creditors for purchase is carried at AC, and the fair value of the amount payable upon initial recognition plus interest if the payment is delayed. Hence, the fair value will be taken on the price per ton. So initial recognition will be 1,000 per ton into the number of tons which the company has purchased. In other words, I would say initially you are recording this at a transaction value. Because in this particular case, it's a case of a trade payable, though you can say it is fair value, but technically it is not fair value. The initial recognition is effectively taken at a price per ton, which is effectively a transaction value, which you can assume is as good as a fair value. Because this is falling under the exception where liabilities will be taken at a transaction value. It very clearly says the transaction price is representative of the fair value. So in this particular illustration, the category is FL at AC, initial recognition at a transaction value, because it is a creditor, which is an exception to the concept of fair value recognition. Let's have a look now on illustration 30. Just reading the question, we have done it earlier. The company is to purchase a portfolio of fixed rate assets financed by fixed rate debenture. Both FAFL subject to same interest rate risk gives opposite changes in fair value. So we've already seen in this particular case that it could reduce and eliminate an accounting mismatch if both the financial assets and the financial liabilities can be taken at FPTPL. So this is a case where I would say this was AC, and this is a case where it is designated at FPTPL. And once it is designated at FPTPL, the fair value changes will not go to the P&L, but due to own credit risk in OCI, and the remaining fair value changes will be taken in the P&L. Because this is not FPTPL, this is designated at FPTPL. Okay, so these are the two examples. Let's see further. There was a small little question further also, which I think maybe I missed it out. Yes, I think I missed that illustration in the study material in this case. There is another question in the study material also, which is given on a derivative liability as well. In fact, there are three questions which are given on recognizing the category of financial liability. One is AC, one is designated at FPTPL, and one they've given a derivative financial liability, and that makes it a combination of three. So three illustrations are given, and each of the illustration, one is AC, one is designated FPTPL, and one is a derivative liability, which is FPTPL itself. This is how do you identify that a given financial liability falls in which category. Now let's go to the issue of accounting as well. So let's now go to the next agenda, that is accounting of the financial liability. So I guess in this particular case, maybe we can just have a look at illustration number 31, which is devoted to this concept, or maybe we can have illustration 32. I think let's look at illustration number 32 because the IRR is also given. So let me just take you to illustration number 32 in this particular case. So you can have a look at the study material. There is some question on a gold which is given, and that question on a gold is actually giving you the insights in terms of things. So let me come to illustration number 32. So let's see the accounting of the financial liabilities at AC. So I guess this part also, let me just crop it up. I will just give you a walkthrough in terms of how it is being accounted for. So let's see illustration number 33. This is financial liability which is being taken at amortized cost accounting. So we will not really look at questions where FPTPL applies because fair value changes taken in P&L is not a big deal. And designated, of course, I said we're not looking at a question. So more or less we're looking at AC. And of course, we'll see special cases. It says A made a borrowing from RBC Bank for 10,000 at a fixed interest rate of 12%. And then it says loan processing fees. Aha. I did not put that in the chart, but you already know that if there is a TC, it is reduced from the financial liability. If there is a processing fee, it is reduced from the financial liability. Typically, if it is a case of AC, not in terms of FPTPL. So one thing which comes to the mind on an immediate level is that you are going to consider fair value minus the TC, and we're going to consider the fair value minus the processing fee. And the moment you see the processing fee, what comes to your mind? Ghanti baji. So what do you say? The moment you look at a processing fee, what should come to the mind? Very good. Effective interest rate as well. So this will also immediately trigger the thought process that EIR is to be taken. So 10,000 is the loan, and processing fee additionally paid is 500, and the loan is payable in 4 half yearly installments of 2,500 each. So we're given the amount of the loan, the starting date and the ending date of the loan for a period of 2 years, and the repayment of the loan starts on 30th September to be paid half yearly. There is two things which are given. The loan is being repaid in 4 half yearly installments of 2,500 each. This is only the principal. So this is given below, and the interest rate is also given 12%. Let's see further. So in any case, 12% is not the EIR. So in this case, we are also given the interest is taken on a quarterly basis. Wow. So in this illustration, they've done some wonderful inputs to you. The payment is made on a 6-monthly basis, but the interest is being charged on a quarterly basis. You know what does this mean? That when you're going to make a ledger account of the financial liability, you need to be very careful. The interest accrued is quarterly, and the principal repayments is supposed to be 6 monthly. So the payment of interest is quarterly and the principal is repaid 6 monthly. This upfront fee is nothing but it is the processing fee. How should the loan be accounted for? Annie's already given you the IRR, which is the effective interest rate as well. Now, this is the amortization chart which is made, but I would like to show you a ledger account, but I'm not going to make a ledger account for all the 2 years in this case. I'll just give you a basic flavor of the kickoff, initially how this account will be done. But I think one thing is pretty clear, that this is a case of a loan, so it is not a derivative liability for sure. It is not a case where we're trying to eliminate or reduce accounting mismatch. So not a case of designated FVTPL for sure. So I would say by default, it becomes an AC category. And once it becomes an AC category, we do the accounting. Let's see. So let me just give you now the inputs in this case. So let's see the solution. I'm going to make a ledger account. I am not going to look at the amortization chart. So let's see the ledger account for the financial liability at AC. So we're looking at the financial liability which is measured at amortized cost account. So let's go back and let's pick up the detail. Now we need to be careful on the dates. The financial year, the loan is taken on April ending on 31st March, and the installments are half yearly. That's correct. But as far as the interest is concerned, quarterly. So let's do one thing. We're going to first take the amount bank account debit and FL gets a credit. Initial recognition is at a fair value minus the amount of processing fee. So we're going to take this 10,000. This is on 1st April X1, I guess. Let me just see the dates. Yes, it was 1st April X1. So this is minus the processing fee. So you recognize the financial liability at 9,500 fair value minus the TC. Now, interest is getting accrued every 6 months at EIR. So on 3 months later, which is supposed to be 30th June X1, we will take the finance charge unwinding at 16.6%. But remember, for a period of 3 months in this case, you need to consider the interest accrued unwinding at a period of 3 months. So 9,500, 16.66% for a period of 3 months, I think is coming to approximately 394, I guess. This is the interest we are getting, I think around 394, if I am right. Just see the calculations also carefully.
Yes.
And by the way, when the calculations have been done in the study, they've not taken 3 months in this case. To be very precise, they've taken the number of days as well. So if you want to get the right calculations, since you're given 1st April to 30th June, count the days. I think that's better. Let's do one thing. Let's do the calculations approximately on the level of days itself. So see, in this particular case, what is the interest on 9,500? We take a 16.6%. And can you give me the number of days from April to 30th June? How many days would that be? I guess it's going to be April plus May plus
91 days.
June. Sorry,
90.
90
91.
days. So 91, I guess, precise. So let's take 91 days and calculate the interest in this case. So 9,500, 16.66 for a period of 91 days, approximately, I think, around 393, I guess. Did we make any payments on 30th June? No. So then we go to 30th September X1, again a finance charge. This time the finance charge will be on the total amount because interest on interest will be taken. So let's take the figure 9,500 plus 393. That's 9,893, 16.6%. Tell me, how many days are you going to get from 1st of July till 30th September? July, August, September. Is it 92 days, I guess?
Yes,
So
sir.
let's see what is the interest for a period of 92 days in this particular case.
400.
And okay. And are we paying the interest on a quarterly or the principal on quarterly? Let's also consider this. Interest charge is quarterly basis and repayment is done.
Here.
Okay, so we're just given the loan is payable in equal installments, but nothing is given for interest. But I guess they've considered the payment of interest each time. So let's do one thing. Let's not take this figure. We are assuming the interest is paid at the end of each quarter. So let's pay the interest on 30th June. So we pay the interest which will be paid on that 10,000 rupee, and that was at the contracted rate, I think was 12%, I think. And this is going to be paid for a quarter, that is 3 months. So we're going to pay the interest every quarter, principal repayments at the end of 6 months. So 10,000, 12%, 3 months, I think is 300. Okay, so when you would calculate the interest now for 30th September, you need to take this figure now. What is the outstanding balance? 9,500 plus interest accrued minus the payment. So I think this is coming to 9,593. Now take 16.6%, 92 days on this. I guess
401.
coming to 401, that's right. And on 30th September, of course, we made another payment as well. We made a payment of the principal also now. So 30th September X1, you got to make 2 payments. One is you'll pay the contractually agreed rate of interest, and you paid the 4 equal installments, 2,500. This is what is paid. But the ledger accounts will not close at this stage. The ledger is going to close only on 31st March. So you need to continuously make this ledger account. Okay, so let's now do another thing. Let's go to 31st December X1 as well, and let's take the finance charge. Can I say the finance charge at this stage is going to be on the entire outstanding balance at this stage? So let's see what is the balance CD effectively in the ledger. Is it coming to 7194? The outstanding balance at this particular stage?
Yes, sir.
Great. And we take a 16.6% interest, and let's see for how many days are we supposed to take in this case now? From 1st October to 31st December.
92 days.
92 days again. So let's see what is the interest. 7194, 16.6%, 92 days, I guess around 301. We make a payment on December X1. So we pay the same contracted rate of 300, that is 12% for a quarterly. Then again, what we need to do, we need to now accrue the interest on 31st March X2. I'll make it only for 1 year, then you can keep making the ledger for 2 years as well. So again, we need to consider the finance chart. So see what is the outstanding balance at this stage. See the balance CD effectively in this ledger.
Sir, I have a doubt.
Yeah.
Sir, on 30th September, we have made an interest principal payment. So the interest will be calculated accordingly, right? For December 31st.
Yes, I've taken the reduction. This is the calculation of the interest on the outstanding balance at this stage. So look at the balance in the ledger. So we're going to take that 7194, which is after 2500 reduction. Yes.
No, so the interest payment.
The interest payment? Yes. You mean to say this 300? No.
Yes, sir.
No. When you're taking this interest, it is getting accrued first and then paid. So you cannot take this 300 reduction to calculate this figure, because you're going to make a payment after the interest gets accrued for the entire period. Right.
No, the payment amount itself should be reduced to the principal paid on 30th September, right? Interest payment of 300.
You're talking about this figure, right?
No, sir. On 31st December to X1, we have paid 300 as interest.
Correct. So
And
you're saying
we
that
have
this
made a
7194
principal repayment on 30th September.
No, principal repayment is happening every 6 months. Principal repayment is happening every 6 months, 30th September, that is done. Next principal repayment will be 31st March. In this case, the interest is paid quarterly and the principal 6 monthly. So there is a difference in terms of when you're paying the principal and the interest. You got my point?
Yeah, sir.
So in this case, this 2500 will be paid September, March, but this 300 will be paid June, September, December, March. Right. Okay, now let's see what is the outstanding balance at this particular stage in this ledger. Is it 7195 or something?
Yes, sir.
So on 7195, you take 16.6%. How many days now to be taken till 31st March? December to March. Seven one nine five 16.6, and how many days are we considering? February would be 28 days, remember? 90 days is it? January 31, March 31, and February 28. So this is 90 days, correct. So this is coming to around 294, is it?
So around 295.
Yes, rounded off to 295. And then we are going to make a payment on 31st March X2. And this time again, we're going to make the 300 plus the principal repayment as well. Now you can take a balance CD as a balancing figure, because now 1 year gets completed. Similar 1 year ledger you can prepare on your own for the next year. So let's see what is the balance CD in this ledger. $4690 is the balancing figure, I think.
Yes, sir.
Correct. So this is 4690, and that's how the ledger account for the next year is also going to be done. Oh, by the way, there is some mistake I have done. I didn't realize that. Once the principal repayment is done, the interest should reduce. Oh my God, I committed an error.
Actually, that was what I was asking. Actually.
Oh, I missed that out. I thought you were talking about something else. Sorry, my error. This 300 is correct. Now this 300 is going to change. And this is also going to change. So we'll have to change the figures as well. December, I think, is correct. But now you need to change the interest. Now the interest will be on 7,500 at the rate of 12%. And that's going to be for a period of 3 months. That's 225. So I think this outstanding balance will undergo a change. So let's see the change in the outstanding balance. 9,500 plus 393, 401, 301. This is 300, 2,800. This is, I guess, now coming to what? 31st December. This is right. Now, what is the balance coming at this stage? Is this coming to 7270 at this stage? And for 90 days, it comes to, I think, around 298 approximately. Okay, and then we got to make a payment of the interest in this particular case. Here again, the interest will be now on interest, of course, here would remain the same. So we have made only one principal repayment. So future will change. So this is going to be on 7,500, 12% for a period of 3 months. That is 225. And we can just change the balancing figure at this stage. I hope the calculations are correct because of the tracking of 6 months principal, 3 months interest. We need to be very careful. Closure is happening March each year. So let's see now what is the balancing figure in this ledger. Is it coming to 4843, I guess? Right, I think now it is correct. So this gives me the movement of the ledger for the period year 1, and then you're also going to get the inputs for the second year on same lines. I think you can make the second year ledger on your own, correct? Okay, so this was the amortized cost accounting in this particular case. There is more questions on the processing fee part as well. Okay. So by the way, I think now we are done in terms of financial liabilities. I now just need to come back and just consolidate the inputs to you. So let me just, I think, quickly consolidate the inputs before we take the journey forward now. In terms of financial liabilities, what we have done in the mind. So I think let me just make a quick mind map on this area. I'm just going to take a little quick mind map on the financial liability area so that everything gets consolidated in the mind. So my focus is been on the financial liability. So let's now consolidate the inputs. You know, I've got two agendas working at the back of my mind. That when you look at a financial liability, its classification is one. And number two, its accounting is second. So I would say in this particular case, there are two focus points. So in terms of the financial liability, my focus point is the classification. And this classification, of course, is meant for subsequent measurement. It is meant for the subsequent measurement. So you need to classify it for the purpose of its subsequent measurement, because initially, of course, it is going to be taken always at a fair value. And then the second focus point is in terms of accounting. And when I'm looking at accounting, my mind is again working at initial level, at initial as well as on a subsequent level. Now, just to get the facts very clear, in terms of the classification parameters, I would put across a question that my minder's default is AC. So what I'm going to look at is it supposed to be held for trading? That's one. Number two, is it supposed to be something which is designated at FPTPL 2, if not AC? So we're going to put it like this, that you are going to first apply a negative list. You're going to first apply a negative list. Ask yourself a question number one. Is it held for trading? You need to put a question number one. Is it held for trading? If you say yes, then it is FVTPL. And if you say no, I'll go to the question number two. So this is how I'll decide my classification, that is it held for trading? If you say yes, it is FPTPL. Then I'll go to the question number two in this particular case. And in question number two, I will say, okay, is it designated at FPTPL? Is it designated at FPTPL? So is there an accounting mismatch which the company wants to reduce or the company wants to eliminate? So if you say yes, then it is again FVTPL. But of course, you know that there is a difference between this FPTPL and this FPTPL for accounting. And if you say no, then I'll consider AC as a default category. So this is what my thought process will be when I'm looking at a classification of financial liability. That let's see, is it held for trading? No. Is it designated? No. Then by default, it becomes an AC in this particular case. Now, moving to the other picture, when you say financial liabilities are accounted initially, they are taken at a fair value. And we can say minus the TC, and we can say minus the processing fee. So this input of reducing the TC and processing fee is going to be applicable for AC. It is going to be applicable for amortized cost, not FPTPL, because FPTPL is going to be expensed off on an immediate basis itself. And when it comes to the subsequent measurements of the financial liability, then in this particular case, we have already made a chart very clear, which gives you which cases the fair value changes are captured. AC, we don't capture fair value changes. FPTPL, we capture fair value changes. And designated, we capture fair value changes, but it is split in OCI P&L. EIR applies to AC, EIR does not apply to FPTPL. So right now the focus is only in terms of AC FPTPL. We're not even looking at the special cases at this stage. So the accounting is covered in terms of chart, where you need to be clear, fair value changes to be accounted or not. AC is no, FPTPL is yes, and EIR AC is yes, and for FPTPL, no. Now only what remains is the special accounting. You've seen the financial liability accounting AC example. Now, financial liability at FPTPL, I would say practically it's as good as FPTPL. So there is no specific illustration devoted to that. But I think if it is FPTPL, just capture the fair value changes in the P&L. Now, if it is a designated FPTPL, there is no question which is dealing with that agenda. So we're not getting into the third category. So I would say the normal accounting is done, AC is done, FPTPL effectively done, designated we're not doing. So what we need to now touch upon is the financial guarantee. Now we need to see that if there is a financial guarantee, how does the accounting of that financial guarantee in the books of the issuer of the guarantee takes place. And I think for that purpose, let's, I think, first give you a break to relax your minds. Then we are going to take up the agenda of financial guarantee accounting. How does that special accounting take place? There was a question in the RTP which dealt with that particular issue, and I'll explain the procedure, how it is done. So far, so good. Right, friends. So I think let's give you a break at this particular stage. We'll join you in around 10-12 minutes time. So enjoy a break. I'll see you in 10-12 minutes time. Thank you. So I hope you had a relaxation of mind. Now, as we take the journey forward from here, I don't want to scare you, but I just want to tell you that now the complicated part of the standard begins. So what has been so far was what? Well, that was quite cool indeed. But of course, now you will see some more nitty-gritties and technicalities coming to the standard. So first we'll of course pick up the concept of financial guarantee accounting with you. And thereafter we need to go to other aspects of the standard, and I'll give you a chain of thought in terms of what are the other aspects in the standard and what are we going to discuss in the next 3 sessions on financial instruments, because we've almost reached, I guess, the 7th class. 70% of the standard is over, which means almost like 2/3 of the standard gets overed. So 1/3, you've got some very interesting issues coming in that we'll discuss later. Let's now come to the concept of the special financial liability, that is a financial guarantee. Now, I'll go a little slow on this part of financial guarantee because this is a slight little complicated area, but I think I need to first of all give you some insights, conceptual understanding regarding this particular kind of case study. So let me, I think, first of all, bring you to a question which came in RTP in May 21. So this was a question which came in May 21 RTP, which is on the financial guarantee. But I think before I read, I just need to give you some conceptual clarity. Few things I'll explain as I solve the question, and few things let me explain at the very inception. Now, you know what you've done earlier at your intermediate level as well, that when somebody takes a bank loan, for example, so let's say, for example, a very simple transaction, there is a company A and there is a company B, and let's say A is the parent of company B. Now, in this particular case, company B takes a loan from the bank. So I think just let's do a little visualization as well. So let's consider the case that there is a company A and there is a company B, and let's say there is a bank as well. Now, what happens in this particular case? B approaches the bank and takes a loan from the bank. So B approaches the bank and he takes a loan from the bank. So B would create an actual liability for sure. So he would represent a financial liability in the books of accounts. Now, bank says that I want a guarantor. You need to, get somebody who's going to give you a guarantee for this loan. So what A does as a part of the exercise, since he is a related party to B, as I already said, that in this particular case, we are assuming that A is supposed to be the holding company of B and B is the subsidiary company. So what A does, A gives a financial guarantee to the bank, and he says that if B doesn't pay, then I am giving you a guarantee. That's what is a financial guarantee. That A is telling the bankers of B that if B fails to pay the money, that I am a guarantor, then I'm going to make good the money. Now, the standard Ind AS 109 makes it very clear that this financial guarantee is an actual liability in the books. When you did your intermediate stage, you always understood in terms of ICAI that if somebody is giving a guarantee, so in terms of ICAI, that is accounting standard, we always said that this is a contingent liability, not captured in the books of accounts. Because this liability will get, triggered only when B fails to pay. So this is a possible obligation and represented as a contingent liability. But Ind AS is very clear that in terms of this financial guarantee, you are going to capture this as an actual liability. It'll appear as an actual liability in the balance sheet. It'll appear as a financial liability in the books of A. You heard me correct. It's going to appear as a financial liability in the books of A. So we are looking at the concept when A gives a guarantee to the bankers for a loan taken by related party B in terms of the books of A, it is a financial guarantee to be captured as an actual liability, and it is going to be measured also at certain value. I didn't say FPTPL, it's going to be measured at a certain value as well. So this is the basic agenda. that we're looking at now the accounting of this financial guarantee in the books of A Limited. I hope my thoughts are very clear at this stage. Now, let's take it further. Let's go back to the example, and now let's have a read at this particular stage. Now, we are given the inputs on 1st April X1, Sun guarantees a 10 lakh loan of the subsidiary. So we can see that Sun is the parent and Moon is the subsidiary company, and the parent gave a guarantee to the banker. So it says which bank has provided for a period of 3 years at 8% interest payments. Interest are made at the end of each year and the principal is repaid at the end of the term loan. That's called a bullet repayment. Now, let's understand one thing. This is how practically also things work. And I think let's also understand this on a very conceptual level. Now, let's come back to the example to understand this particular aspect. In this particular transaction, now you can see one thing very clear. That when B approaches the bank for a loan, the bankers would say that we are going to give you a loan, let's say at the interest rate of 10%. So let's say the bankers tell B that we'll give you a loan at the rate of interest rate of 10%. Then they say, sir, can you give us a guarantee? And he gets the guarantee of A. Now, this interest is at the rate of 10% when there is no financial guarantee, and the interest which will be charged when there is a financial guarantee will certainly lower down. If the banker is getting a security, he's getting a guarantee, he might agree. I'm not saying he will always agree, but he might agree to reduce the interest rate. Because in this particular case, he knows that the loan is not going to go bad. So he may agree to give you a loan at a lesser rate of interest and there is no financial guarantee. So the standard requires us that from a point of view of A, who is the guarantor, he needs to basically see what kind of advantage has he given to B Limited. Because if B Limited would have taken a loan without a guarantee, he would have paid a 10% interest to the bank. But since A is given a guarantee, B is able to fetch a loan at the rate of 8%. So the difference of 2% is the benefits which A has given to B. So the benefits which A is given to B is supposed to be captured as a fair value of the financial liability. So what A Limited will do, he will basically evaluate that if B would have taken a loan without guarantee, he would have paid 10%. If he took a loan with a guarantee of A, he's getting a loan at the interest rate of 8%. So the 2% saving, the 2% benefit which B gets is supposed to be, you can say, a liability on the part of A. So every year, B is able to save that 2% interest outflow for the loan tenure. So what we can do, we can take the present value of the 2% interest saved, and the present value of that interest saved every year becomes the fair value of the financial liability. So at the initial, when you go to recognize this fair value at a financial liability, it is basically equal to the benefit derived by B. So A will capture this liability at the benefit derived by B, which is the present value of the interest saved for the tenure of the loan. I hope I am making sense. Now, let's take it further. Let's go back to the question. It says now, if Sun Limited is not issued, it's not issued a guarantee, the bank would have charged Moon an interest rate of 11%. So we can clearly see the bank is giving an 8% interest with a guarantee, and it would have given 11% interest rate without a guarantee. So the difference between 11 and 8, that is the 3% benefit which Moon got. So we need to capture the present value of all those interest savings, and that is the fair value of the financial liability in the books of Sun. Then he says Sun does not charge Moon for providing the guarantee, related party. Then he says at the end of the year on 31st March. Now, this is the initial recognition of the liability, that when you're going to record things at initial level. So in this particular case, initially, when you capture the financial liability, you need to consider the interest which is there without a guarantee. the interest which is there with a guarantee and the differential interest is discounted, that becomes the fair value liability at the inception. Now comes the question, how would you account for this liability at a subsequent stage? How would this liability be accounted at each year end in this particular case? Now, the standard is giving us some data. The question is giving us some data, but let's, I think, first analyze this because we are not aware of the concept of impairment. I'm not taught you the concept of impairment. So we need to, I think, first visualize back again. Now, in terms of the subsequent aspect, let's, I think, continue with the example to understand the bits. Now, in terms of the subsequent aspect, let's consider a time scale. Let's consider a time scale, and let's say this is the date when the loan was given. The loan was given. Let's say this is the balance sheet date. Let's say year one. Let's say this is the balance sheet date, which is year two. Now we're looking at things from the holding company's point of view. We're looking at things from the holding company's point of view, which is given a guarantee. So what he does at the very inception, he captures the guarantee. He captures this guarantee, as we said, at a fair value, which is nothing but at the present value of, you can say, the interest, the present value of the interest benefit, which goes to the subsidiary company. So he takes the present value of all the interest benefits, discounts them, and he gets the fair value. Now, if you remember, in terms of Ind AS, I've always maintained a particular input. I've always said that in terms of Ind AS, if you ever use the concept of discounting, you are always going to do the concept of compounding, that is unwinding. So this liability is measured at the present value of all the future benefits. So what you've done a discounting. So what you need to do, you need to do compounding, or that is called unwinding. So in this particular stage, at the end of first year, I will do the unwinding of this amount and get the figure. I'll do the unwinding and get the figure. Basically, I will do the compounding of this fair value. Since I took the present value of the interest saved, I'm going to do the discount compounding, which is unwinding. But the real position, what needs to be seen at this particular stage is, the holding company will now sit down and analyze that if the subsidy doesn't pay, then what is my financial liability? This calculation is purely an unwinding of the fair value. But then the parent company needs to sit down and make a visualization that if the subsidiary company doesn't pay the money at the end of first year, then what is my liability which is going to trigger? Which means now at this particular stage, he needs to assume a default. He needs to assume a default, which is technically called, assume that you want to calculate an impairment. Because when you're saying that there is a default, there will be a non-payment by the subsidy to the bankers, and the liability of the parent company would get triggered in this particular case. So the parent company is going to now sit down and assume a default, and he is going to calculate what is the possible impairment loss. You can say in simple words, the non-recovery which will take place. Now, how do you calculate an impairment loss is something which we have not yet learned, because we will be learning the concept of ECL, that is expected credit loss model, under Ind AS 109 to consider how the impairment loss provisions are done. So he will assume a default at this particular stage and consider that if a default occurs, then what is the amount of impairment loss which the parent company will have to bear. So this impairment loss will be computed using what we call the ECL model, expected credit loss model, on the balance sheet date. Now the question arises that you've got two values in hand. You've got two values in hand. One is the value which is based on post unwinding, and one is the value that if a default occurs, then in that particular case, what is the liability of the parent company which could trigger. So he will sit down and see that if a default occurs, this is the amount which is payable, and this is the figure which is based on unwinding. So in this particular case, what he needs to do, he needs to record the financial liability at the higher of the two figures. Don't worry, I'll consolidate this as well. So in this particular case, what he needs to do at this stage, he needs to unwind this amount and he needs to record the financial liability, or you can say the financial guarantee, at the greater of the two. And this exercise is going to be repeated at each year end. At each year end, this exercise will be repeated, and that's how the financial guarantee will be accounted for. Very complicated indeed. I think let me put this picture once again to consolidate, then we'll see in the practical illustration how the accounting of this financial guarantees are done. So moral of the story, if you're looking at a guarantor, number one, unlike the ICAI, it's not a contingent liability to be disclosed in the notes to accounts. It is supposed to be an actual liability to be captured as a financial liability, and this is the special case what we're looking at. So there are two aspects in terms of financial guarantee. One is how do you record it initially, and number two, how do you record it on a subsequent basis. The initial value of this liability is to be taken at a fair value. You need to sit down and see that my subsidiary company, for that matter, if they would have taken a loan without guarantee, what is the interest rate? If they would have taken a loan with a guarantee, what is the interest rate? So what kind of benefits have I given to my subsidiary because of this guarantee? So whatever interest reduction is taken place, the reduction in interest will be discounted at time value of money and captured as a fair value of the liability. So at the initial level, it is recorded at a fair value, which is the present value of the interest benefit given to the subsidiary. And then what you need to do at each balance sheet date, as far as subsequent accounting of this liability is concerned, you need to first of all unwind this figure because it is based on a present value. So you need to basically unwind this figure. And secondly, what you need to do, consider that if a default occurs at this particular stage, what is the liability amount which will trigger in terms of the parent? So we need to basically calculate a provision for impairment loss, assuming that there is a default, apply an expected credit loss model, and based on that calculate what is the impairment loss. The liability will be recorded at the unwinded figure or the impairment loss provisioning, whichever is greater. Then in this particular case, once you have taken the fair value at the inception and the higher value at this particular stage, the difference between these values, because it is recorded at a fair value at the inception and at the higher of the two values at the end of the year, the difference in these values will be captured in the profit and loss account. So this will be captured in the profit and loss. Indirectly, you can say we are following an FVTPL. But remember, at the end of the year, you're not calculating a fair value. So it is wrong to say that it is a fair value through P&L. I would say you are capturing the difference between the fair value and the higher value at the end of the year that is captured in the P&L. So it is similar to the concept of FVTPL, but it's not exactly capturing the fair value changes at the end of each year. Wow. So with this understanding, let's come back to the question as well. I think if somebody has not done the accounting in terms of financial guarantee earlier, and if he faces a question in the exam, don't get disheartened, but I think it is not possible that a person would be able to do this. Nobody, but now you've done it, so you know how the accounting takes place. Let's come back on the agenda now. Now it says on 31st March X2 year end, there is a 1% probability that Moon may default on the loan in the next 12 months. And if Moon defaults, Sun does not expect any recovery. He is not expecting to recover any amount from Moon. So this status is given so that we can calculate that if a default occurs, then what is the liability of Sun? Then on the next year, March X3, the probability of default has gone up to 3% in the next 12 months. And if Moon defaults on the loan, Sun does not expect to recover any amount from Moon. Provide the accounting treatment of the financial guarantee in the books of Sun Limited, which is the parent company, on the initial recognition and in the subsequent periods till March X3. Wonderful indeed. So we are required in this particular case to measure the financial liability initially at the present value of the interest benefit given to the subsidiary and then consider the accounting subsequently. Let's have a look. So let me, I think, now solve this particular question to you. So we are looking at the solution of this financial guarantee. So let's see the entry in the books of the parent company, that is in the books of Sun. Let's capture the fair value of the financial guarantee. So this is what we are doing in the books of the parent company, that is Sun Limited. So in this particular case, we need to first of all go for an initial measurement. We need to go in for an initial measure saved, the present value of the interest saved for Moon Limited. So whatever is the interest he's got saved, because of this, we're going to capture that. So I guess we've already seen the data. So let me just pick up the inputs. So we're very clearly given that the interest rate without the guarantee would have been at the rate of 11%, and with the guarantee, it is 8%. So we can see the interest is at the rate of 11% with no FG. There is no financial guarantee, versus the interest is at the rate of 8% with FG, that is the financial guarantee. So we can say the saving in this particular case is at the rate of 3%. So you need to calculate this 3% in absolute figures and convert this into a fair value. So in this particular case, I guess the loan figure was, I think, 10 lakh rupees. So on this 10 lakh rupees, you will take a 3%. And since there is a bullet repayment, the loan is not repaid at the end of each year. There is an interest payment, but the loan principal is bullet payment at the end of 3 years. You can take a 3% common for all 3 years put together. And let's see what is the PVIFA, which is at the rate of 11% for a period of 3 years to calculate the present value. So let's see what is the discounting factor at 11% for 3 years. I guess this is 2.444 rounded off. This is to the extent of 2.444. So on 10 lakh rupees, a 3% into 2.444 is coming to 73,320 is the fair value of this financial guarantee at the very inception. Super. Okay, now what we need to do, we need to now go at the end of each year. So let's first put the entries in the books of the parent. So what is the entry he is going to record at the very inception? So let's see the journal entry as well. Well, in this particular case, since he is given this particular guarantee, he is going to capture an investment in the subsidiary and then recognize a corresponding financial liability, which is the financial guarantee. So he is going to put an entry in the books of accounts, that is investment. This is investment in the subsidiary company, will be given a debit, and the financial liability, brackets I'm writing financial guarantee, is recorded at the fair value, that is 73,320. So this is the entry which is done at the very inception. Now let's see the accounting at the end of 2 years. He's basically asking us to show the accounting for a period of 2 years. This is the entry done on 1st April X1, and now we need to show the accounting at the end of X2 as well as at the end of X3. So let's begin the picture on a time scale back again. So if I were to put this on a time scale, just to look at the entries carefully, from 1st April X1 and on 31st March X2 and then on 31st March X3. So let's see the entries on a time scale so we can see the capturing. So the entry we have already done on 1st April X1 was investment in subsidiary, and financial liability, that is financial guarantee given a credit, which is to the extent of 73,320 that we've already captured. Now, at the end of the balance sheet date, as I said, you need to do unwinding, one, and you need to consider that if there is a default, then what is the liability which will trigger? So we need to consider two figures and take the higher of the following. So we need to first of all calculate a value post unwinding of discount. I need to calculate a value which is post unwinding of discount. So the 73,320 will be compounded at the rate of 11%. You did a discounting, so compounded at 11%. Now, since 1 year is lapsed, which I did not say earlier, can I say in this particular case, you can say that the benefit of 3% for a period of 1 year is already obtained. So from this figure of unwinding, you will also reduce the benefit of 30,000, which is the 3% benefit already obtained. So when you calculate this particular figure, what do you need to consider? You need to consider the figure which is unwind at 11% and then make a reduction of the 3% benefit since 1 year benefit is already obtained. This is more or less like a case where you're creating a financial liability at something like an amortized cost approach. Just for understanding point of view, if you were to look at this like a ledger, you can say in terms of the ledger, it looks like this, that you recorded 73,320, unwinded the interest at the rate of 11%, that is 8065, and then the benefits given is like debited, and you get a balance CD as a balancing figure. So this calculations, what we have done is exactly like making a financial liability ledger account as well. Just considering an unwinding and also reducing the benefits already paid to the subsidiary company. So not only that unwinding is taken, but the benefit reduction of 1 year is taken. So 73,320 unwinded minus 30, and that comes to 51385. This is 51385. This is the value of the financial liability, which is more or less taken at amortized cost approach, I would say conceptually. Then the second input which we need to calculate in this particular case is that assume a default. Assume that there is a default, and let's see what is the amount of liability which will trigger for the parent company in this particular case. So let's go back to the data and let's see what is the amount that would trigger. It says on March X2, there is a 1% probability that default might occur. So if there's a 1% probability that a default might occur in this particular case, what am I supposed to do? 10 lakh is the principal amount and this amount which might be payable. There is a 1% chance that the liability of the parent company might trigger. So we are going to create a provision based on the probability of default occurrence. So 1% probability that this default will occur. So this works out at 10,000. So we need to consider in this particular case the higher of the two. So in this particular case, we need to record this value at 51,385. So we need to record this at 51,385. So what do we do at the end of the first year now? Compare the value at the beginning and the value which you've computed being the higher of the two. Difference is supposed to be taken in the P&L. So we're going to compare this figure and this figure. And in this particular case, financial liability is gone down. So we will put the entry that is financial liability gets a debit and the amount of profit and loss gets a credit. The reduction indirectly in the fair value of this liability is a gain which is captured in the P&L. So 73,320 minus 51,385, that works out at 21,935. And a similar exercise is going to be done at the end of March X3 as well. Let's do the calculations at the end of March X3 as well. So in this particular case, if I go to March X3, again, I need to calculate the higher of the two figures as we did on March X2. You're going to again calculate the value which is post unwinding of discount. So in this particular case, let's calculate the value which is post unwinding of discount. And this will again be considered now the figure which is 51,385 compounded at 11% minus the benefits already given to the subsidiary. Another benefit of 3% on the loan value, the benefits is given, unwind the closing balance at 11% minus the benefits. So let's see what is the value in this particular case. I guess this comes to 27037. 27037. And if you consider that assuming a default, what is the amount which might be payable by the parent company? Assume that a default occurs at this particular stage, what is going to be the impact? So let's come back on the agenda and let's see on March X2, what is the status? Sorry, March X3. On March X3, there is a 3% probability that defaults may occur. So from 1%, it is become a 3% default in probability. So in this particular case, on 10 lakh rupees, you've got a 3% default probability that works out at 30,000. So we again need to consider the higher of the two. So higher of the two in this particular case is supposed to be 30,000. Because now if the liability triggers, in that particular case, it is supposed to be 30. You need to capture the liability which I might have to pay if it triggers in this particular case. So again, what do we do for comparison? Your value in the books of accounts is now standing at this figure. So this difference, that is 51,385 and 30. So we need to decrease this liability. So similar entry will be done for the difference that is 21,385. So this is how the accounting of the financial guarantees are going to take place. So we need to basically, in this particular case, capture the differences at the end of each year. So you should be clear the value which is captured on day one, that is the fair value, the present value, the benefits. And then you need to consider the greater of the two at the end of each year, that if you unwind, what is the figure? If it triggers, then what is the figure? Higher of the two. And the differences are captured in the P&L. The gain or loss, whatever, is going to be captured in the P&L each year. Wonderful indeed. So I think that takes care of all the inputs as far as financial liability is concerned. Now, if you go back and see what we have covered on financial instruments, I think we have covered the entire aspect of issuer, its accounting as well, the presentation accounting, as well as the holder, everything. So from financial assets to financial liability to compound financial instruments to equity, everything is done. What next is the agenda? What are we going to discuss further in this case? So let's get on to the mind map at this stage. What is now going to be done further? In fact, you can also read later in terms of the study mat out here as well on the financial guarantee, where it says the financial guarantee is taken at the higher of the loss allowance, assuming a default, and the amount initially recognized less when appropriate, the cumulative amount of income recognized in accordance with Ind AS. I've explained that in simple words, but this is where the measurements is given. Okay, so I think now it's time to, I guess, give you some inputs and see what are we going to cover the journey forward. So let me now take it further and let's add some inputs at this stage. Now watch this carefully. As we move ahead now, we need to be clear on terms of things. I know a lot of things in terms of financial instruments, and you need to be very clear in terms of thought process. There is something more which is given in the study material which I didn't talk of. I am going to talk of it now at this particular stage. As I said, now the financial instruments, the remaining portion is going to be a bit more technical, because the level is going to now get more strengthened as well. Few areas have also been tested in the exams. Few areas, in fact, have not even been tested so far as well. Now watch this carefully. I am just creating a small little mind map so that we are very clear on the picture. Where do we stand today and where do we need to go in the next 3 sessions as well? So we'll just take a very little time to just illustrate the inputs and then take a journey forwards. Now, your mind, I'm going to add a few things as I am discussing things. I'm going to add a few things as well. So please watch this carefully. Please watch this very carefully because I'm going to add a few things also at this particular stage. Let me just draw a little more straight line. So I'm just going to add a few things also at this particular stage. Now, number one, our journey started in terms of Index 32 and the focus was on the issuer. I'm going to add something, friends. Please watch this carefully. We decided that there are basically 2 parties on a financial instrument contract. And when we decided that there are 2 parties in terms of financial instruments contract, we said one is an issuer and we said the other is supposed to be the holder. Now, when we decided from the issuer point of view, we've covered 4, but I'm adding now the 5th category, which I mentioned one particular day as well. So in this particular case, when you're focusing on the issuer, the first is that you are looking at the classification. You are looking at a classification of the instrument. And now at this stage, I would say, when you're looking at the classification of the instrument, I would say there are basically a total of 5 kinds of instruments. So but you taught us 4. As I said, I'm going to add some more inputs as well. So there are basically a total of 5 categories of instruments which can turn out to be. The first category of instrument is that you classify this as an equity instrument, or you classify this as a financial liability or a compound financial instruments, which is non-derivative, or it is a hybrid contract, which is supposed to be a case of embedded derivative. And the 5th category, which I think I want to add now, is called a deemed equity instruments. So there is another particular input that is called a deemed equity instruments in this case, which we have not touched so far. But if you look at the study material, in that particular case, fortunately, unfortunately, there has been no question which has ever been asked in terms of deemed equity instruments, but there is a deeper guidance given in terms of para number 16A, para number 16B, para number 16C, and para 16D. What is this concept of deemed equity instruments? Let's just give you a very basic flavor of the same, because I will touch upon this area only if I get time towards the end. But since it has not been touched in exams ever, I'm not taking up this area at this stage, but let me at least give you a thought process where you just can read the inputs, and there are a couple of illustrations given for each conditions out there. Many times what can happen, a company may have a capital structure where they have got no pure equity instruments. Hear me carefully. A company may have a capital structure where they may have no pure equity instruments. In this particular cases, certain financial liabilities meeting certain criteria are designated to be considered as good as equity instruments. You heard me correct. So when the company in its capital structure has got no pure equity instruments because they've got all puttable instruments. If you remember, when I gave you the concept of equity instruments, I very clearly made a mention that equity instrument is supposed to be a non-puttable equity instruments, where the holder has got no right, to put the instruments back to the issuer, and they're basically non-puttable instruments, then only they can become equity instruments. Many times in a company, like for example, mutual fund companies, which do not have a share capital, so they may have units of mutual funds. In those particular cases, they may not have any non-puttable instruments, but they may have only puttable instruments. So if a company has got no non-puttable instruments, but they've got any kind of puttable instruments in this case, so what we need to do in this particular case, these instruments these instruments, if they meet certain conditions which are given in the para number 16 ABCD, which I said, they may be considered and presented as good as deemed equity instruments. They're not going to be considered as equity instruments for accounting. They're only going to be considered as a deemed equity instruments for presentation purposes. So this deemed equity instrument is that financial liabilities are considered for presentation. They are considered for presentation as equity instruments, not for accounting, only from the balance sheet point of view. So financial liabilities are considered for presentation as good as equity instruments. So this is one area of discussion which is given. The accounting of these instruments is not discussed, but we're given that there are certain instruments, and these instruments, putable instruments, need to meet the conditions. They need to meet the conditions in the para 16 ABCD. I'll put it as para number 16A to para number 16D. And there are a total of 7 conditions which are given, and they are called instrument specific conditions, issuer specific conditions. So there are a very stringent 7 conditions. You need to meet all those 7 conditions, and then you can call the instrument that it is to be presented as good as an equity instrument. So therefore it is called a deemed equity instrument. So this discussion is not what we did, but I said let's give you at this point of time. So the concept of deemed equity instruments would arise when a company has got no non-putable instruments, it has got only putable instruments. So the company will have to decide that out of these putable instruments, those which are going to meet a total of 7 conditions in all, if they meet those 7 conditions, so let me just make a mention that there are a total of 7 conditions. So once they meet those conditions, they may be presented in the balance sheet as equity instruments in that case. That's one. Now, moving forward, now I guess if I take a further connect as well, I would say in terms of the further connect, equity instruments, we didn't do the discounting, but we very clearly said that the entry is bank gets a debit, equity share capital, and a security premium gets a credit. So there is no subsequent accounting which is done for an equity instrument. So naturally, we've not done any questions on this area. Our focus in terms of accounting has not been there. So the next area of discussion was in terms of accounting. The next area of discussion was in terms of accounting. So we never did any specific accounting for equity instruments, but we know that equity share capital remains intact as it is. Now, moving further in terms of the financial liabilities, we are done with the accounting. So we know that there are 4 categories of financial liability that should go at the back of the mind. You've got financial liabilities at AC, at FPTPL, as well as designated FPTPL, as well as the case of special liabilities where you've seen financial guarantees. So these 4 categories you've already seen today itself, and you've seen that it could be a case of AC, it could be FPTPL, or it is designated at FPTPL, or there are certain special liabilities, and one of the special liabilities we've seen is financial guarantee. Another special liability, which is a financial liability arising when FA cannot be de-recognized, we're going to see that later. Okay. Then in terms of compound financial instruments, we've seen the accounting in terms of the split accounting, and we've also done a variety of instruments here as well. And in terms of the variety of instruments you've seen the concept of CCD, OCD, the compulsory, PCD, partially convertible, perpetual instruments. So here also you've seen basically a total of 4 instruments again. So you've seen the concept of 4 instruments, that is optionally convertible, partially convertible, compulsorily convertible, and a case of perpetual instruments. We've done detailed accountings on that. So EI not really touched, not required. Financial liabilities done. Now we're done with the entire accounting of financial liability. CFI done. Hybrid instruments, unfortunately, of course, we didn't do any question on that. We understood the larger concept, but there was no question where, we segregated the embedded derivative on those instruments. We just understood the concept. But yes, we've done the accounting, but no practical illustrations done. So I'll not give it a cross. I will say that we have covered the concept, but there is no question as such what we have covered on this area, because we don't have a question where the valuations of the options is given. So now you can see in terms of issuer, when you sit down, your mind should be very clear that, okay, if it is equity instrument, I know the accounting. If it is a CFI, I know the accounting. If it is a pure financial liability, I know the accounting. Hybrid instruments, I know the concept, but I've not seen a practical illustration on that. And even for deemed equity instruments, the concept is there, but there is no accounting given. But this is only when the company has got no non-putable instruments. So putable instruments are classified as good as deemed equity instruments only for the presentation aspect, not otherwise, only for the presentation aspect. I hope, friends, my chain of thought is pretty much clear at this particular stage. That is on the categories. Now comes the other agenda as well, holders' perspective, what we have seen. Now, in terms of the holder's point of view in this particular case, what I'm looking at is the financial assets. And in terms of financial assets also, we've seen all the kind of categories as well. So when you look at the holder's point of view, we saw the classifications in terms of largely the debt investments and largely the equity investments, and also I would say the derivative investments as well. So we covered the aspect in terms of a debt investments, equity investments, and a derivative investments. And within the debt and the equity investments, we saw the subcategories as well. And we did a plethora of questions on that. On the debt instruments, we covered that it can be AC, it can be fair value through OCI, which is with a recycling, or it could be an FPTPL. And even in terms of the equity investments, we got the blend that there could be two kinds of equity investments, either FPTPL or it is FPTOCI, and equity is as well. We covered examples covering each and every category of accounting in this case. I did all the 5 cases with you. We covered all the 5 cases. Derivative, of course, we have covered the concept so far. So we covered the concept of derivatives in this case, but yes, we are yet to do examples in this case. The examples are going to be covered later when we come to the concept of embedded derivative. This is, the crux which should go at the back of your mind when you're looking at the concept of financial instruments. Your mind should be absolutely clear on all the permutation combinations which arise. I hope this helps, because when you want to make a revision as well, you need to be very clear on the issuer perspective, the holder's perspective as well, that what are the various permutation combinations done. I know you must be feeling this is too much indeed. The things are yet awaited more. Now, what is more what we need to do? Now we're progressing further in terms of what we're going to do further. So there's more on financial instruments. Yes. Now, let's, I think, add on to this mind map further at this particular stage as well. I'm just now telling you what is the way forward in terms of my journey, what I am going to do, so that your mind is now clear in terms of things. That was in terms of what we have covered so far. And now we are looking at some more issues which we need to discuss, something from the issuer, something from the holder's perspective and all. But I think let's put it commonly. Now, I would say in terms of way forward, there are certain special issues what we need to discuss. There are certain special issues what we need to discuss, and let me give you the list of those issues and then we'll start working on them. The first special issue what we need to discuss is the concept of what is called a derecognition. A derecognition, you've already heard the term with me. I said it's a removal of an asset or it's a removal of a liability from the books of accounts. That means removal of the financial asset and removal of the financial liability. So we are going to cover the derecognition of financial assets separately and financial liability separately. So derecognition is basically the removal. But when you say it's a removal of financial assets and liability out of the books of accounts, in this particular case, the removal of the financial assets and liability is something which has got certain criteria to be met. You need to meet certain criteria before you can actually say that a removal can happen. So what we're going to do, we will see the criteria for derecognition of financial assets. We will look at the criteria for derecognition of financial liabilities, and we'll also going to look at the accounting. So in this particular case, my thought process is going to be to give you the criteria for derecognition, that is one, and also to give you the accounting for a derecognition, that is two. That's what my first journey is going to start on, because right now the focus has been recognizing the asset and liability in the books, accounting it on a recognition. Now comes the derecognition, removal of the assets and liability, the criterias and the accounting. Then comes the other special agenda, and that is called impairment. Wow. This is a very interesting concept indeed. Of course, it can be very challenging in a practical life situations when you're looking at the concept of impairment. And in terms of impairment, we're going to basically cover what is called the expected credit loss model. This is called an expected credit loss model, that is popularly called ECL. This is what we popularly call it as ECL, that is an expected credit loss model. You've done impairment in terms of Index 36, which is basically dealing with impairment in terms of non-financial assets. But here we are looking at impairment in terms of financial assets. And for this, there is a different model. Index 36 doesn't apply, but the concept of impairment under Index 109 applies, which is called ECL, expected credit loss model. And of course, when you're looking in terms of the impairment testing, this concept is applicable to financial assets. Of course, financial liabilities are not impaired. So this special issue of impairment is going to be applicable only in terms of financial assets. So we're going to see how the ECL modeling works. And that's not the end. We've got another agenda. Another agenda, last one, sir? No, second last agenda as well. So the next area of discussion is what is called hedging. Now, hedging is a very specialized kind of accounting where the companies would enter into, certain derivative contracts and try to protect their assets and liabilities in the balance sheet, or maybe not in the balance sheet as well. And this hedging is something which is a complete option on the part of the company. It is not mandatory, and we need to see what is the accounting for hedging. So we're going to see the accounting as far as hedging is concerned, because this involves a specialized accounting. It is going to overrule certain accountings which are done earlier. You heard me correct. It's going to overrule certain areas of accounting as we progress further. But this is what is called hedge accounting, specialized accounting, which is a complete option. And of course, the journey doesn't end at this stage. There is another inputs as well. And the other area of discussions is what is called ED, not Enforcement Directorate. It is called embedded derivatives. So we need to do the discussions of what is called embedded derivatives as well. So now in this particular case, whatever we need to discuss is a part of the special accounting, the way forward. We're going to understand the derecognitions, impairment, hedgings, and embedded derivatives. And I'm not scaring you, friends. I'm not scaring you. Please don't take me otherwise. But all these areas are quite complicated indeed. The kind of pressure your mind is going to now take moving forward is going to be very different from what you have covered. So I'm just trying to make up your minds that, as we're going to go forward in terms of things, these areas are very technical indeed. Most of the people I know, what they do, they just cram up the concepts in this case. They've got no clarity on derecognitions, impairment, hedging, and even embedded derivative. Because if you look at the frequency in terms of things, hedging has been very less frequent. I think the frequency is not very great. Embedded derivatives also has come in the exams a little more than hedging, of course, and derecognitions also very less. mainly on liability, not on assets. Impairment also very less. The frequency of these areas are less, but of course we need to be expert. The idea is not that you just need to pass the exam. The idea, as I said in the inception, is also to become a good professional as well. And you become a good professional only when your knowledge is at a good level. So we are, of course, going to go deep into these areas as well. So let me do one thing. I am now going to give you a little briefing on the concept of derecognition for the next 10 minutes before we close. And I am going to first go, let me tell you the order in which I'm going to move as well. I'll cover the concept of derecognition. Then I'm interested in covering the concept of hedging. Then I'm interested in covering the concept of impairment. Then I'll cover the concept of embedded derivatives. That's how my journey will move forward. So after this, all these issues, in AS 109, financial instruments will take place. So these 4 issues is what we're going to cover in the next 3 sessions with you. There are larger areas, of course, but we're going to cover these 3 things in the next 3 sessions with you. So let's begin with the concept of a derecognition. I did not scare you. I was just trying to make you aware in terms of the things, just to tell you that, now what we're going to do is going to be slightly technical indeed. The next 3 classes, please get mentally prepared. The level will be definitely more as compared to these 7 classes we have done. But if you want to strengthen your concepts, you will get everything. But you need to carefully understand, revise the concepts. You will get the logics in terms of things. Let's begin. So I am coming to the concept of what is called derecognition of financial assets. Liabilities we'll discuss separately. Let's first discuss the concept of derecognition of financial assets. The standard has given us a very interesting chart, which I will not share at this stage. I will share you to, of course, in the next class, but I'm just going to make some grounding work at this stage. I remember, very clearly in school, we were given a very interesting concept. I'll just remind you back. My company made a credit sale. So the entry which we used to do is debtors or trade receivable gets a debit and the sale gets a credit when you make a credit sale. Secondly, when you drew a bill of exchange is drawn upon the customer. Then in that particular case, we put the entry, bill receivable gets a debit and a trade receivable or debtor gets a credit. And when this bill is discounted from the bankers, then on the discounting, when the bill of exchange is discounted with the bankers, then in this particular case, we put the entry, and the entry in this case is bank gets a debit. And of course, you consider a discount also is given a debit, any discount, and the bill receivable also gets a credit at this particular stage. So this is the entries, the sequence of entries which we used to pass when a bill of exchange was drawn and discounted in the books of accounts. What if I tell you today that the entry for discounting the bill of exchange is wrong? What if I tell you that this entry in terms of index is not technically correct? How can you derecognize a bill of exchange? Because if you notice in this particular case, what you've done, the bill receivable, which was recorded as a financial asset, is being given a credit. So there has been a derecognition of financial asset on discounting. And trust me, you cannot do that. We're going to learn the principles where we can say that you cannot give a credit to the bill of exchange when you, in this particular case, discounted a bill. The standard 109 has laid down certain parameters, or I would say it has laid down certain tests. So I'm just going to give you a thought process regarding this test, which I will remind you, of course, in the next session as well. But there are a total of 3 tests which the standard is given. So I am again going to give you a 3-step model in terms of deciding the criteria whether you can derecognize a financial asset out of the books of accounts or not. And the standard has given us a total of 3 tests in this case. The test number 1 is called a cash flow test. The test number 1 is called a cash flow test. Now, I will not get into what is a cash flow test, but you need to meet the parameters of a cash flow test. If the company does not meet the cash flow test, I'm saying if you do not meet the cash flow test, you will not be able to remove the asset from the books of accounts. If you meet the cash flow test, then there is a possibility that I need to conduct what is called a risk and reward test in this particular case. So just keep the basic chain in mind that when you apply the cash flow test, in that particular case, if you fail the cash flow test, the asset cannot be removed from the balance sheet of the company. But if you meet the cash flow test, in majority of the cases, you'll have to go to the second step and conduct a risk and a reward test. If the risk and reward test passes, derecognition can be done from the books of accounts. I will be able to derecognize the asset from the books of accounts. But in certain cases where the risk and reward fails, I will not be able to derecognize the asset in the books of accounts. And in certain cases, when the risk and reward fails, so there are three cases. The risk and reward passes, then I will be able to derecognize. The risk and reward fails, so there will be two cases. In some cases, you will not be able to derecognize. And in some cases, you are going to go to the step number 3 and we're going to conduct another test, which is called a control test. So you can say if the cash flow is met, generally you're going to go to the risk and reward. So cash flow is simple. You fail the cash flow, no derecognition. You pass the cash flow, generally you're going to go to the risk and reward. You pass the risk and reward, derecognition. You fail the risk and reward, then in that particular case, depends. In some cases, I'll prohibit you from derecognition. In certain cases, I will say you can go to the step number 3, check out the control test. If the control test passes, derecognition. If the control test fails, no derecognition. So the criteria for removal of the financial asset from the balance sheet of the company is being divided into a 3 test criteria. There is a need to conduct a cash flow test and a risk and reward test, and sometimes the need may be to conduct a control test. So with the help of these 3 criteria and tests, we will be able to decide whether a bill of exchange, a bill receivable, can be credited, can it be removed from the books of accounts or not. And remember, just to connect you, that if I am not able to put this entry, then I will put an entry bank debit financial liability credit. So when the financial asset is not eligible for derecognition, it could lead to a creation of a financial liability, which is one of the categories of FL I gave you. I very clearly said that if a financial asset is not eligible for a derecognition, then it could lead to financial liability. So you're going to see in terms of bill of exchange that we will put an entry bank debit FL credit. Discounting a bill of exchange, you're going to see, is more like taking a borrowing rather than a case of removal of the assets in the books of accounts. But once we get the hold of these parameters, we'll get a larger picture clear. I think that seems to be quite good for the day. Must be feeling a bit heavy as well. If yes, good, excellent. So what do you need to do? Keep doing a cumulative revision in terms of things. So in the next session, friends, we're going to take the journey forward in terms of derecognitions, first of all, then hedging, then impairment, and then ED, embedded derivatives. Okay, excellent teaching logic. Each time I feel that was wonderful. I just got your message. Each time I feel there is a lot to be learned from you besides what you teach. Thanks for your valuable efforts and given to us. Thank you, Pooja. That means quite a lot. Yes, till the last class, the notes have been uploaded, I guess. I'll still check it out, but I think the notes are there. You can just check it. Even immediately after the class, I generally do upload the notes on an immediate basis, of course. Okay, friends, if you've got any questions, otherwise, we're going to see you in the next class at the same time. Thank you, Vida. Haji.